Have you been watching the silver market lately? On the surface, things might seem normal. Prices go up, prices go down. That's just what markets do, right? But if you zoom in and connect the dots between a few key developments, a fascinating and potentially significant pattern starts to emerge. It's not about one single price spike or a dramatic headline. It's about the subtle interplay between paper markets, physical supply, and something as simple as the time of day. Let's start with a curious observation from recent trading sessions. Based on public data, silver has shown a tendency to climb higher during hours when the main U.S. futures markets are closed. While North America sleeps, trading continues full steam ahead in Asia and the Middle East. This isn't a new phenomenon, but its recent persistence is noteworthy. It suggests that demand from other parts of the world is exerting a strong influence, one that becomes most visible when the Western markets aren't active. It's a powerful reminder that silver is a truly global asset. The COMEX in New York is a major hub, but it's not the only game in town. The Shanghai Futures Exchange, the Shanghai Gold Exchange, and trading centers in Dubai and London all play a crucial role in discovering the true price of silver 24 hours a day. When U.S. markets close for a weekend or a holiday, the trading baton is passed around the globe, and sometimes this reveals underlying market pressures that are smoothed over during regular hours. To really get what's happening, we need to understand how the silver futures market works. Think of a futures contract as a promise to buy or sell a set amount of silver, in this case, 5,000 troy ounces on the COMEX, at a specific price on a future date. The market is made up of all sorts of players: miners and refiners hedging their production, industrial users like solar panel makers locking in their costs, and financial traders speculating on price movements. The total number of these outstanding contracts is called open interest. And lately, open interest in silver has been unusually high. A high open interest isn't necessarily a red flag, but it does mean there's a massive amount of obligations that need to be settled. Most of these contracts, over 95% typically, are settled in cash before they expire. A trader simply closes their position and either takes a profit or a loss. But a small fraction of these contracts go all the way to physical delivery. This is where the holder of a long contract actually takes ownership of physical silver bars from an approved warehouse. The entire system is built on the assumption that only a tiny percentage will ever ask for the metal. This is where it gets really interesting. The physical silver backing these contracts is stored in special vaults and is split into two categories: registered and eligible. Registered silver is like a package on the loading dock, sealed and ready for delivery against a futures contract. It's fully committed. Eligible silver, on the other hand, is like inventory in the back of the warehouse. It meets all the quality standards, but its owner hasn't yet flagged it for delivery. It could become registered, but that's a choice the owner has to make, usually driven by financial incentives. Now, what we've seen recently is a significant and sustained decline in the amount of registered silver. The pile of silver ready for immediate delivery has been shrinking. At the same time, the total amount of open interest, those outstanding paper claims, has remained high. You see the potential disconnect? A large and stable number of paper claims and a shrinking pile of metal set aside to back them up. Think of it like a game of musical chairs. As long as the music is playing and everyone is just trading paper back and forth, the number of chairs doesn't seem to matter. But when the music stops at delivery month, some people will want a physical chair to sit on. If the number of players wanting a chair starts to rival the number of available chairs, things get tense. This is what some analysts are pointing to. The ratio of open interest to registered silver has been climbing to historically high levels. This means each ounce of registered silver is now backing a much larger amount of paper claims than it used to. Again, this doesn't guarantee a crisis. The eligible inventory is still there, and it can be converted to registered. But that conversion isn't automatic. It requires owners of that eligible silver to be willing to part with it at the current price. If they believe prices are heading higher, they might just hold on, forcing those who need to deliver silver to bid up the price to convince them to sell. This brings us to the structure of the market itself. For years, there have been debates about the level of concentration in the silver futures market, particularly on the short side, that is, the traders betting on prices to fall. Data from the Commitment of Traders Report, or COT report, shows that a small number of large commercial banks often hold massive short positions. Historically, this has been interpreted as banks hedging for their producer clients, but the sheer size of these positions has led some to question whether they also act to suppress price rallies. When a powerful, concentrated group of sellers faces a diffuse, unorganized group of buyers, the sellers often have the advantage. They can absorb buying pressure and manage price increases. However, this dynamic only works as long as the demand is primarily for paper contracts. If a significant number of buyers start demanding physical delivery instead of just a cash settlement, the game changes completely. A short seller can't deliver a paper promise, They must deliver real physical metal. If they don't have it, they have to go into the open market and buy it, whatever the cost. This is known as a short squeeze. So let's put all the pieces together. 1, we're seeing upward price pressure during non-US trading hours, suggesting strong global physical demand. 2, we have a shrinking pool of registered silver available for immediate delivery on the COMEX. 3, we have a persistently high level of open interest, meaning a large number of paper claims on that shrinking physical supply. And 4, we have a market structure with a high concentration of short positions held by a few large players. When you connect these dots, the pattern that emerges is one of increasing tension between the paper market and the physical market. The paper tail has been wagging the physical dog for a long time, but the dog is starting to pull back. The drain on registered inventories, combined with robust demand from Asia, could be putting real stress on the ability of short sellers to maintain control. Every ounce that leaves the registered category makes it that much harder to fulfill delivery obligations without scrambling for metal in the open market. This isn't about predicting a specific price or a specific date for some kind of market explosion. It's about recognizing a structural vulnerability that has been building for some time. The global nature of the silver market means that pressures can build up in one part of the world and then spill over into others. The demand we're seeing in Shanghai or Dubai doesn't just stay there. It ultimately puts a claim on the same global pool of silver that the COMEX relies on. For decades, the futures market has been the primary driver of silver's price. But we may be entering a period where the physical market reasserts its authority. If more and more investors choose to take delivery or simply buy physical coins and bars outside the future system, it could force a major repricing as the paper market is forced to catch up with physical reality. The key thing to watch will be the inventory levels in those COMEX and London vaults. As long as those stockpiles continue to drain while open interest remains high, this underlying tension will only grow. It's a quiet but powerful story unfolding behind the daily noise of the market. And it's one that every serious investor should be paying close attention to. Thanks for watching, and be sure to subscribe for more deep dives into the markets. Have you ever wondered what's really going on with the silver market? You might hear whispers online about shortages, paper claims, and big banks. Today, we're going to cut through the noise and look at what the data actually tells us about silver inventories, market structure, and why things might feel a little tight right now. This is a deep dive, so grab a coffee and let's get into it. First, let's talk about COMEX, the main futures exchange for silver. If you look at the vault reports from recent years, you'll see a clear trend. Total silver inventories have been declining. We're talking about both categories: registered, which is ready for delivery, and eligible, which could be made ready. Now, this doesn't mean silver is vanishing into thin air. It's simply moving. It's being bought by private investors and stored outside the COMEX system. It's being used in industries like solar and electronics, or it's being allocated elsewhere. The key takeaway is that the pool of silver readily available for futures contract delivery is smaller than it used to be. This is where the famous paper versus physical ratio comes into play. You'll often see analysts comparing the total number of ounces claimed by futures contracts, known as open interest, to the amount of registered silver in the vaults. When this ratio is high, it means there are many more paper claims than there is physical metal immediately available to back them up. Now, a high ratio doesn't automatically signal a market collapse or default. The entire system is built on the assumption that most traders will settle their contracts for cash, not demand physical delivery. And most of the time, that's exactly what happens. But here's the catch. What if that changes? What if more participants than usual decide they want the actual metal? Even a small increase in delivery demand could put significant pressure on those shrinking inventories. The market has built-in safety valves for this. We might see the price of silver adjust upwards, or the price difference between contract months, known as spreads, might change to make it more attractive to settle in cash. These are normal market functions designed to maintain balance, not signs of a broken system. But they do highlight how sensitive the market can be to shifts in physical demand. Now, let's add another fascinating layer to this puzzle: market concentration. The Commodity Futures Trading Commission, or CFTC, publishes reports that show who is holding what positions in the market. And in silver, these reports consistently reveal that a very small number of large players, mostly big banks, hold a massive share of the short positions. In other words, they are betting on the price of silver going down or staying stable. This level of concentration is quite unusual compared to many other commodities, and it's been a feature of the silver market for a very long time. So, what's the explanation? The most common one is that these large banks are acting as intermediaries. When their clients want to go long on silver, buying futures contracts, the banks take the other side of that trade. They then manage their own risk by hedging in various ways. They might hold physical silver themselves, use options, or engage in other complex financial strategies that aren't visible in the public futures data. Because we can't see their full playbook, it's hard to draw definitive conclusions. They might appear massively short on the exchange. but they could be perfectly hedged behind the scenes. However, we can't ignore the signals coming from the physical market itself. Have you tried buying silver coins or bars recently? You've probably noticed that the premiums, the amount you pay over the spot price of silver, have been unusually high at times. These premiums cover costs like manufacturing and distribution, but when they stay elevated for long periods, it can be a red flag. It suggests that there's friction in the supply chain and that demand is outstripping the immediate supply of retail products. This isn't just a local phenomenon. We've seen similar signals from exchanges in Asia, where reported inventories have also been dropping year after year. Let's put all these pieces together. On one hand, we have declining COMEX inventories, which shrinks the buffer for physical delivery. On the other hand, we have a highly concentrated group of large players with massive short positions, relying on the market to continue functioning as it always has, with most contracts settling in cash. And underpinning all of this, we have persistent tightness in the physical market, evidenced by high premiums and falling inventories worldwide. This creates a fascinating dynamic. The system works, but it appears to be operating with a smaller margin of error than in the past. The levers and mechanisms that balance the paper and physical markets are still in place, but any unexpected surge in physical demand could test them in ways we haven't seen for a while. It's not about predicting a crisis, but about understanding the pressures building within the system. The relationship between the vast paper market and the finite physical supply is becoming more and more important to watch. So, what should an investor or just a curious observer take away from all this? It's crucial to look beyond the daily price fluctuations. The real story is in these structural details. The flow of metal in and out of exchange vaults, the concentration of positions, and the premiums in the physical market. These are the indicators that give us a deeper understanding of the health and potential vulnerabilities of the silver market. It's a complex and interconnected system, and while it's designed to be robust, the current conditions suggest that it's a very interesting time to be paying close attention. Thanks for joining me on this deep dive into the silver market. It's a topic with endless layers, and we've only scratched the surface. If you found this analysis helpful and want to learn more, make sure to like this video and subscribe to the channel for more content like this. Let me know your thoughts in the comments below. See you in the next one. Have you ever wondered why silver seems to be on everyone's radar lately? It's not just about shiny coins or family heirlooms. There's a fascinating story unfolding behind the scenes, a classic tale of supply and demand, and it's creating some serious pressure in the market. Today we're going to dive deep into what's happening with silver and why the situation is becoming more and more interesting. Silver is unique. It's not just a precious metal people buy for investment. It's a critical industrial commodity. This dual identity is the key to understanding the current market dynamics. Think of it as having two massive engines driving its demand, and one of them is running hotter than ever. Let's start with the demand side, specifically industrial consumption. This isn't just a small part of the picture, it's a huge growing force. The green energy revolution is a massive driver here. Take solar panels, for example. Silver is an essential component in photovoltaic cells because it's an incredible conductor of electricity. As the world pushes for more renewable energy, the demand for solar panels skyrockets, and with it, the demand for silver. Industry estimates show that solar panel manufacturing now eats up a huge and growing chunk of the silver produced each year. But it doesn't stop there. The electrification of everything is another powerful trend. Electric vehicles use more silver than their gasoline-powered counterparts. Your smartphone, your laptop, the vast data centers that power our digital world, they all need silver for their circuitry and components. Then you have medical applications, where silver's antimicrobial properties make it invaluable. This isn't discretionary demand. These industries can't just decide to use less silver without affecting performance. They need it, and their need is growing steadily. So, with all this incredible demand, you'd expect silver miners to be working overtime to pull more of it out of the ground, right? Well, here's where the story gets complicated. Let's flip to the supply side. Global mine production simply hasn't kept pace with this surge in demand. One of the main reasons for this is that most silver isn't mined on its own. It's usually a byproduct. Miners are often digging for other metals like gold, copper, lead, or zinc, and silver just happens to come along for the ride. This means that even if the price of silver goes up, it might not be profitable for a copper mine, for instance, to increase its overall production just to get a little more silver. Their primary focus is the main metal they're after. This structure limits the industry's ability to quickly respond to higher silver prices. What about opening new mines dedicated just to silver? That's a great idea in theory, but it's a slow and incredibly expensive process. We're talking about years, sometimes over a decade, from discovery to production. You have to navigate complex permitting processes, secure massive financing, and then undertake the huge task of construction. It's a long, risky road, and it can't provide a quick fix to a supply squeeze. Then we have recycling. Recycling does contribute a meaningful amount to the annual supply. Old jewelry, silverware, and electronic waste can all be melted down to recover the silver. However, recycling has its own limits. Think about all the tiny amounts of silver spread across billions of electronic devices worldwide. It's incredibly dispersed, which makes collecting and processing it economically challenging. So while recycling helps, it can't single-handedly fill the gap. So what happens when demand consistently outpaces supply? You get a deficit. For several years now, the silver market has been in a structural deficit, meaning the world is consuming more silver than is being produced from mines and recycling combined. It's like spending more money than you earn year after year. How is this even possible? Where does the extra silver come from? It comes from drawing down existing stockpiles. These are the large, above-ground inventories held in vaults around the world, like those at the London Bullion Market Association or the COMEX Exchange. Every year there's a deficit. These stockpiles get a little smaller. Think of it as a global savings account for silver. For a while, you can cover your overspending by dipping into your savings. But if you keep doing it year after year, that savings account starts to get uncomfortably low, and that's precisely what's been happening. Over multiple years, this steady drawdown has been reducing the buffer of available silver. This buffer is crucial because it helps the market absorb shocks, like a sudden surge in demand or an unexpected disruption at a major mine. As the buffer shrinks, the market becomes more fragile and more sensitive to any changes. Now, does all of this guarantee that the price of silver is about to launch into the stratosphere? No, not necessarily. Markets are incredibly complex. They can remain unbalanced for a lot longer than anyone expects. There are other factors to consider. For example, if there's a global economic slowdown, industrial demand could cool off. Engineers are also constantly working to use materials more efficiently, a process called thrifting, which could reduce the amount of silver needed per solar panel or per electronic device over time. There's also the possibility of substitution, where industries might find cheaper alternatives to silver, although for many of its key applications, there are no good substitutes. It's also possible that the reported deficits aren't telling the whole story. Maybe there are unaccounted for private inventories out there, or perhaps the demand figures are a bit more flexible than they appear. These are all valid counterpoints that add nuance to the situation. But even with those caveats, what we can say with confidence is that the margin for error in the silver market has narrowed significantly. Let me explain what that means. When inventories are massive and overflowing, the logistics of getting the metal from point A to point B don't matter as much. There's plenty to go around. But when inventories are lean, things get tricky. The timing of deliveries, the location of the metal, and the specific preferences of buyers, like wanting a particular bar size or brand, suddenly become much more important. A delay in a shipment or a preference for physical delivery over a paper contract can cause ripples through the market that wouldn't have been felt when stockpiles were high. This is the real crux of the issue. The shrinking buffer makes the entire system more brittle. We're moving from a situation of abundance to a situation of scarcity. It's a gradual process, not an overnight event, but the trend is clear. The fundamental mismatch between rapidly growing, non-discretionary industrial demand and a constrained, slow-to-respond supply is creating a foundational pressure that's hard to ignore. This dynamic between its role as money and its role as an essential industrial material makes silver one of the most compelling commodities to watch right now. The interplay of green energy, technology, mining geology, and global finance is all converging on this one metal. While no one has a crystal ball, understanding these powerful underlying forces is the first step to making sense of what might come next for the price of silver. The stage is set, the players are in motion, and the fundamental story is one of growing tension. It's a story we'll definitely be keeping a close eye on. Thanks for watching today. If you found this breakdown helpful, be sure to hit that like button and subscribe to the channel for more deep dives into the markets. Let me know your thoughts on the silver market in the comments below. See you next time.